Hello and good morning. Thank you for taking time out of your busy day again to join me. My name is Ray Reyes. I'm with Latitudes Training, Coaching, and Consulting. And this is part three of a four-part series for exit strategies for language service providers. Today we're going to talk about how to determine what your business is worth. When thinking about selling your business, the first question business owners ask is, how much is my business worth? Unfortunately, there is no easy answer to that question. Entire books have been written about valuation models. There are so many variables involved that different experts looking at the same company end up with different selling prices. There are, however, some commonly accepted accounting techniques and some rules of thumb that are used, but it's all very confusing, especially if you're the seller. We'll look at these in general, but we'll also look at what's most common in the language services space. Starting at the end of 2012, we at Latitudes have represented clients on the buy side, and in that process has spoke with dozens of potential sellers, all of whom had a look of bewilderment on their face when we got to what their business was worth. I can tell you this, not once did a seller say, "Really? That's great." But before we get into that, let's look at the four fundamentals and types of value that are out there. The four types of value are asset value, equity value, enterprise value, and liquidation value. Asset value is a commonly transaction-oriented fair market value conclusion. What that means is that asset values include the firm's and your company's inventory, your furniture, fixtures, equipment, PCs, basically all of the intangible assets ranging from intangible assets ranging from customer base to goodwill. But it does exclude all liquid financial assets and all liabilities. And the buyer in the asset value model operates under a new name. The old company, his name is not used in a legal entity. Next, we'll look at equity value. Equity value includes the asset value plus liquid financial assets, less all liabilities, both short-term and long-term. It also means the full transfer of the legal entity, including all account balances and current tax liabilities. The acquiring company may or may not retain the name of the business. Naturally, the value associated with these two distinct transactions can be substantially different. In practical terms, the seller keeps the cash and receivables, but delivers the business free and clear of all debt in the asset paradigm. In the equity sale, the buyer is acquiring all of the asset and liabilities on and off the balance sheet. In the real world, there are many variations on these basic structures. For example, the asset sale might include accounts on the books, your AR, your accounts receivable, monies due from whomever, but they also might exclude long-term debt. And both the asset value and equity value are fair market values of ongoing concern basis, meaning they reflect the sale, meaning that they're fair market value driven. However, one reflects the asset sale and one reflects the equity sale, as the name indicates. Then we have enterprise value, which is a reflection of your company's value in its entirety. And it's helpful in that it facilitates a comparison from one company to the other. Think of enterprise value as a theoretical takeover price. Someone's going to come out and just buy you. In the event of this buyout, the buying company would take all your debt, it would take your cash, but it would also take on all the assets as well. There's significantly from simple market capitalization in several ways. I hope you understand what simple market capitalization is. You may consider it more of a representation of the overall company's value. The value of a company's debt, for example, would need to be paid by the buyer when taking the company. Thus, enterprise value provides a much more accurate valuation because it includes debt, both long term and short term. Then we have the liquidation value. And the liquidation value is exactly how as it sounds. The net amount that would be realized if the business is terminated and all of the assets are sold piece by piece. This is a sad case and unfortunate, and typically liquidations are a result of a bankruptcy or litigation. Hopefully, none of you will ever have to experience a liquidation valuation as your stuff is being sold in the courthouse steps or other ways. It is the unfortunate demise of the company once you get to this point. Now that we've discussed the four types of value from an accounting perspective, let's look at what is most commonly used in language services industry, and that's the company's ability to generate sales, cash flow, and or profits. Sure, there are value adds such as technologies, processes, attrition rates, customer types, revenue types, even specific expertise. But it's been our experience and from the research that we've done that most of the value of a LSP comes from two areas: top line sales and the EBITDA numbers. It's really simple. How good a company is at selling its services and how efficient they are in keeping the cash. But if you're overpaying linguists or selling below industry averages or have other high costs, your value will quickly be reduced. The truth is, you have to do a lot of great things to increase your valuation multiplier, but it doesn't take much for that multiplier to be reduced. Let's look at valuing a business based on sales. The top line sales times the multiplier model isn't used that often in our industry. But let's take a quick look at it. The multiplier depends on the predictability of sales from year to year and what the growth rate has been over the last 5 years. How much of your business is contractual versus transactional, and how much of your business is represented by your top accounts. If you have 1, 2, or even 3 large accounts that make up of more than 50% of your business, your multiplier will be greatly reduced. But if your revenue is spread out over several accounts, steady streams, steady growth over those 5 years, your multiplier can be increased. Basically, if your business has low fixed costs, few assets, and little retained earnings, the sales multiplier technique may be the only appropriate way to value your business. So if you don't have a lot of assets or a lot of liabilities, and you're still trying to figure out how to make money, but you have a solid solid sales growth, this top line sales multiplier model may be the only option for you. But what we found is the most common area, and that's EBITDA, right? Earnings before interest, tax, depreciation, and amortization. Valuing a company using cash flow or profits is how we have seen our industry gravitate towards that model. I mean, I'm not going to split hairs here, right? Even though there are some differences between cash flow and earnings, the philosophy is the same. The price is based on the company's ability to generate a profit, which can be defined in a lot of ways, right? Or cash flow, sales less expenses. The seller then can project the stream over a period of time, typically somewhere between 3 and 5 years, and then they calculate the value of your business. They discount for future earnings based on interest and attrition, and then they take a look at some of the strengths and lengths of your contracts. The model comes X times earnings, profits, EBITDA. That's it, and that's a simple, straightforward way to value your business. So if you have a company and you're challenged in being efficient in your bottom line, then you can be rest assured that the valuation multiplier you're going to be used will be on the low side of the market. In the last few months, we have spoke with a dozen or so potential sellers, all of whom questioned how the multiplier was created that determined the value of their business. And my first statement to them was, don't shoot the messenger, right? Because I've been asked many times if the multiplier is some subjective number that the seller came up with and kind of just pull the rabbit out of a hat using some fancy accounting techniques. The truth is, sure, there's a lot of room for speculation, but typically a profitable, healthy LSP with good growth in sales, very efficient profitability, will look to be sold for somewhere in the area between 2.5 to 4 times earnings, EBITDA, net. So if your cash flow is $200,000, the sales price on that will be somewhere between $500,000 and $800,000. Now, if your net is $1 million, now you're looking at somewhere between 2.5 and 4 million. But there are a lot of other factors, as we talked about, that can affect that. If you look at some of the things we discussed earlier about some of the factors that can impact your business, even with the multiplier range already in place, you can still move that number up and down. Some factors will have a positive impact on your business and attract buyers, and then other factors will have a negative impact on your business and run buyers off. Examples of positive factors that raise your multipliers include proprietary products or technologies, strong brands or patents or a trademark, definitely add value. A diversified customer base with no one customer having more than 10% of sales is a huge factor in your business value. A strong management team, right, with very few key people who agree to stay on with the new company. Or you're in a space where you have weak competitors and you have a healthy market share in that specific space. Another positive factor are efficiencies in your production process. Are you well automated versus being labor intensive? In the interpreting world, if you're still relying heavily on people for scheduling and your idea to grow is throwing more bodies into scheduling, this will increase your operating costs, which in turn will bring a lower multiple. However, if you're using technologies to grow your business, this also can raise your multiplier. And in this translation space, if you are effectively using a translation management system or other technologies and using real-time review and streamlining the turnaround process, there's a lot of value there. But if your QA process is old school, where you finish a project, you send it to the customer, they review it, they send it back to you with edits, and you send it back and forth, this is very labor intensive, and there is a low value there. In fact, that would probably want to be one of the biggest negative impacts on the valuation of your company is the lack of technologies in the translation space. And of course, there's the obvious. You don't want to have any pending legal or government action against you. Let's look at the negative factors that have an impact to lower your multiple. When I talk to some of our clients or prospective clients and ask them what separates you and what's your value proposition or what makes you different, and they come across with our quality and or how we have all these, we can do this in 100 languages and 20 different verticals. That sounds great when you're talking to somebody in the elevator, but when you're talking to somebody who knows the industry, you completely just water down your business to having very little value. You're nothing more than a transaction company. You are commoditized. Everyone would know that you've outsourced that to linguists all over the world, and you really can't control and manage quality in 140 languages. And the Me Too products, right? Although we do this just like our competitors, and using that as a differentiator in your sales value. That's going to reduce your multiplier as well. Or if you have one or two or three customers that make up more than 25% of sales each, that would quickly diminish your value. And as I mentioned before, poor or inefficient processes that have high labor costs. Pending legal, government, IRS problems will lower your value like a lead weight around your ankle in the ocean. And you have to understand that the financial ratios that we utilize are fine-tuned for our industry, but they cross verticals. and if your company has even one of these negative factors, then you're just a very typical LSP, right? It's not that you're a bad business, because there is no perfect business, but buyers will use these factors to negotiate your price down. So you need to make a mental note, work up a plan to convince them, or at least be able to adequately explain them, or fix them before you get into the due diligence part of selling your company. The truth is, there isn't a secret sauce or magic financial equation to determine the value of your company. You actually determine the value of your company every day. The choices and decisions you make have a direct impact on the value of your business. Using old technologies, choosing to stay with the status quo, not having a professional sales team, not implementing a strategy and methodology, using antiquated technologies that are inefficient, or if you have a poor management team, all of these will have a negative impact on the value of your business. And the longer you stay with them, the longer, the longer you stay with them, the lower your valuation will become. Just as, if you start utilizing new technologies to increase efficiencies, if you adopt and execute on a sales methodology for a growth plan, if you have a high performance sales team in place, or if you redefine your target markets to be more narrowly focused and leverage your strengths, all of these things will have a positive impact on your valuation model. So what's the bottom line when determining your value? Although there are a lot of different valuation models, the most common valuation model in our industry is a multiple of the EBITDA. And taking all of those other things into consideration, the operational issues, technology factors, sales stuff, all will add or decrease to that valuation. At the end of the day, when it comes time to sell your company, you either accept this multiple or you don't. Ultimately, only you can make that decision. However, if you have your exit strategy in place, if you have a plan that you want to execute on, if you have a goal in sight and there is life after your LSP, then my recommendation is that you take a look at all these efficiencies and try to fix them to bring a higher valuation to your company. Well, that's all for today. It was short and sweet. I hope that I was able to give you at least a thumbnail sketch of valuation models for LSPs. If you have any questions or you need more information, please feel free to reach out to me. My email address is on the screen. It's rreyes@latitudescoach.com. You can also reach me on Twitter, LinkedIn, Skype, and also with Google. Thank you very much. Have a great day.